Good morning, Platinum Top 50. Thank you guys so much for joining us. This is definitely some uncharted territory and time for us. And we are so glad to be able to realize that we can still deliver to you meaningful connections through the online space. What a whirlwind it has been for all of us these last 3 weeks. And I certainly know that lending and mortgages is a hot topic for you guys. So, we asked the question, what kind of content are you interested in? What conversations do you want to be having? And overwhelmingly, the response was related to lending and mortgages. So at Platinum Top 50, we are so privileged to partner with top industry professionals. And we have for you today a panel that is made up of 4 agents, or 4 lenders, that is, and then an agent, Tasha Carlson, who is going to help me kind of frame some questions to make sure that we are delivering for you the information that you want to hear. So let me just run through some of the topics, right, that you can expect over the next 50 minutes. We're going to talk about the overall state of the market. We're going to cover rates. We know how volatile those are. We're going to cover loan products. We're going to cover appraisals. We're going to cover contingencies and forbearance, jumbo loans. So tons of information over the next 50 minutes. And again, we're just so grateful to have a community of top agents. We're grateful to have a community of top lending partners. And we are all in this together. And that's really the message that I want to send out today, right? We're in this together. We're stronger together. So the more that we can come together to communicate, to learn, to share, the better we're all going to end up. So I'd love to ask Tasha Carlson, our agent, kind of on the panel today, to introduce herself and tell you a little bit about herself.
Okay, so I'm Tasha Carlson. I have a small brokerage, Marathon Real Estate. I've been involved in Austin real estate since 2002 and started the company in 2006. And I just was excited to see this post on Facebook asking questions and the feedback we got from agents. So excited to be a part of it and learn from these fabulous lenders. Thanks, Amber.
Yeah, because Tasha, I would imagine that lending and mortgages kind of plays a big role into what
Absolutely.
you are on the front lines dealing with now. So what do you have to say about that?
Absolutely. I mean, I just am trying to be a sponge right now and learn as much as I can. I want to be a resource for my clients. And so I love that we have these wonderful people we can go to and they can educate us so we can help educate our clients.
Absolutely. Like I said, we're all in this together. And this industry has always been one that relies on a lot of relationships, right? And so we're so grateful to have our lenders take time to share with us their wisdom, their insights, because they are the experts in this field, right? And so hopefully today they're going to give us information that lets the agents feel more confident to be able to go out and have conversations with their clients that adds value to the whole thing. So let's go ahead and introduce some of our panelists. Let's see, let's go ahead and start. Josh Brown with Legacy Mutual Mortgage. Will you introduce yourselves to our audience and tell them a little bit about your professional work in lending?
Hi, Josh Brown here. Been a lender since 2003. So I've already kind of seen a cycle back in '08 with what's kind of happening now, which I'll address later on. And then really appreciate Amber and Tasha making me part of this. So excited about it today and happy to help out in what I can.
Awesome. Thanks, Josh. Next up, Xander, will you introduce yourself?
Hi, I'm Xander with Prime Lending. I've been with the company for 16 years. I've been in lending for 20 years. And this is the second time we've seen a liquidity crunch. First one being in 2008. We learned a lot of valuable lessons from that. The situation is a little different. So I look forward to sharing some of what we've learned here over a pretty wild last 4 weeks. I'm happy to be here.
Awesome. Thanks so much. John, you're up.
Hey everybody, John McClellan here, Supreme Lending. I've been in the business a little over 25 years. This is probably the 3rd big meltdown that I've seen. Well, maybe even 4 if you count 9/11, but even before that in the late 90s, there was a little bit of a mortgage meltdown at that point too. So I'm excited to be part of this panel today. Hope we can give some good information out there so you can disseminate it to your clients and help them deal with the crisis we're going through right now.
Wonderful. Thanks so much. And Greg?
Yeah, hey, good morning. Hope everybody's doing well. And Amber, again, thanks for including me on this panel. I appreciate it. I am with South Star Bank. We're a community bank, do a lot of portfolio lending, and I have been in the banking business my entire career, just north of 25 years. So hopefully everybody today will get some good information out of this. And again, I appreciate you putting this together.
Absolutely. Well, I did some quick math there, and not to age you guys, but it looks like we've got over 75 years of collective experience on this panel. And so I think that just that alone goes to show our audience, right, the value of your perceptions. And we're so grateful. You know, John, when you say you've been through 3 or 4 of these crises, right, I'll be real honest, as a business owner, this is my first one. I started my business in January of 2008, so I've never experienced anything like this. And it's very comforting in finding wisdom with people who have ridden these out before.
Yeah, I would say that probably the majority of real estate agents and mortgage people in the market right now have never seen a downturn.
Exactly. Yep. And so it's just the collective wisdom is so much appreciated for us that haven't. So let's go ahead and roll into our first question, which I would love to direct towards Josh Brown over there with Legacy. You know, Josh, like I said, I've never been through a crisis like this. I got my business in January of 2008. Awesome time to start a business in real estate, everyone would know. But on that note, right, can you just shine some light on what are some of the similarities and differences between this financial circumstance and the mortgage meltdown of 2008?
Yeah, so, you know, one thing I would definitely say that's kind of similar would be preparation. I feel like in 08 and 20, we weren't prepared both times. You know, obviously in this market, no one saw a pandemic or a virus kind of causing all the issues and problems out there. And really, you look at the speed at which it happened. I mean, 3 weeks, this has all kind of gone down. You know, 3 weeks to about a month. As far as, you know, 08 and 20, I think big differences too are going to be credit was a huge part of 08, being the meltdown with the subprime. And then a lot of loans that people got were subprime, and there was you know, a lot of speculation going on about, you know, buying lots of houses that you couldn't probably afford, and then the home prices going higher. And then obviously with that, in that 08 bucket, we had a lot of years of foreclosure to go through. I think that the big difference between 20 and 08 is definitely liquidity. So I think all around it's the biggest piece by far. You know, everyone right now needs cash. They're not interested in, you know, certain products or, you know, buying securities. There's also, you know, a lot of uncertainty out there. And so when people are uncertain about times, you know, cash is kind of key. And then, you know, as far as, you know, there's definitely lots of speed at which things are changing. And I feel like in 08, there was a lot of time where you may see some investors fall off and some things would kind of go away. But in 20, I feel like a lot of things have been cut like within a couple of weeks. So it was not really drawn out at all. It just really kind of just ended pretty quickly. I think some positive notes. I think inventory was overbuilt in 08. I also think now we have, you know, lower inventory. So I think that's definitely a huge difference because people still, you know, are still enough of houses that they need to buy. So,
You know, Josh, it's interesting. Again, you know, I've only had my business for over 10 years. So, you know, I was a baby in the business in 2008. But certainly 2008 was a housing crisis. That is and was our industry that was at the forefront. And, you know, it's obvious that right now, those industries that are getting hit the hardest is food and beverage, right? It's travel. And so I think through this one too, again, just from a bird's eye view, another obvious difference is that our industry isn't on the forefront of this crisis yet. Tasha, let me ask you as an agent, is there anything that you want to add to this conversation as far as the differences or maybe questions for Josh before we move to the next question?
I would just echo what he said. I just feel like we're starting from a much stronger place. it has a very different, there's some similarities, but it has a very different feel because we're starting, I think Josh, your words were we're cash heavy right now, but people have been making money and been, you know, financially solid. So it feels different in that regard.
Good. So certainly a takeaway for agents, right? A way to let your clients know that this is not the same as 2008, and there's a lot of differences between the two. So that's awesome. All right, Xander, I have a question for you, right? Let's talk about rates because they are super volatile right now. And I'm hoping that you can help answer the question of why are rates so volatile right now? And when do you think they're going to stabilize?
That seems to be the question of the day, Amber. We've seen rates drop as far as 3% on a conventional 30-year fixed, and the 15-year hit the mid-twos. And that was sort of late February, early March. The first drop kind of started happening in January. And then the morning after the Fed announcement where they cut short-term rates, long-term rates actually jumped a half point overnight and then went up as much of a point that week, which to the average homeowner doesn't make any sense. They see the Fed cuts rates, they just assume that trickles down to long-term rates, but that's controlled by totally different indexes. So whenever you have a liquidity crunch, the normal mechanics of how a market works get thrown out the window. You've got big banks that got inundated with billions of dollars of refi volume that the only way to turn off the tap was to raise rates. So that probably caused about a half point jump. And then you started to see problems in the jumbo market with investors pulling products, pulling out of the market altogether. Yesterday, Wells Fargo pulled their jumbo product. And that's generally a sign of they're trying to limit their risk in the market. And banks just want to do middle of the road conventional loans with no risk, meaning no higher debt to income, no higher LTV, no lower FICO. We're starting to see changes to the FHA and VA minimum requirements FICO wise. And this is where we're going to be for a little while. The same thing did happen in 2008, but that was a different vector that caused it. That was a total collapse and lack of trust in the banking system in terms of how to properly value an asset. This is an external force where there's still trust in the market, but what we've seen is forced selling across all asset classes, from bonds to stocks and everything. And that's causing these huge swings in bond yields and the Dow, obviously. And we're going to continue seeing that intraday volatility where we may quote a rate that's gone an hour later. So the only thing I can recommend is if you see a rate that's there, jump on it, because it may not be there in an hour or two.
Tasha, do you have a follow-up? Because I know yesterday when we were kind of running through this, talking about rates, right? One of the questions you mentioned that agents are getting a lot is, should I lock now or should I wait? And if I lock now, right, what are the options for relocking if rates drop further? So do either of y'all have something to add to that kind of question, comments?
Yeah, that's certainly questions I'm getting, but I defer the answer to Xander. What are your thoughts on that? If clients are asking, should we lock now or wait? And then asking about relocking, what does that look like?
The answer is yes, lock now. Most lenders have a free float down option. Not all of them, so definitely check with that. Where if you lock a conventional fixed rate on a 15 or 30-year fix, most of them will do a one-time float down. So you don't have to worry about timing the dips. On the jumbo market, even though the jumbo fixed pricing is higher, it's not going to get any better anytime soon. Jumbo arms are still competitive. That's just going to get worse. So if you've got a jumbo loan, you may be out of the refi window, but on a purchase, I would lock quickly. We are recommending folks do longer term locks. Appraisals are going to take about twice as long as they usually do, anywhere from 2 to 3 weeks and longer in some cases, just because a lot of the appraisers have pulled themselves out of the pool. We are seeing a lot more drive-by inspections allowed, which is helping. We can touch on appraisals later, but the answer, should I lock now, is yes, because you want to play defense in a market like this. And if the market does take a significant drop, we offer a free one-time float down to match the market prior to closing.
So Xander, we had someone, Lauren, hi Lauren Besmer, question in, and she said, what about people who are already under contract with a jumbo loan at Wells Fargo? Will they be able to close?
Yes, they will. Locks are good up through today. That said, if there's any kind of exceptions needed, they won't be granted. So you have to make sure the loan is within underwriting guidelines. If it's any kind of risky loan, they'll find a way to probably shoot it down in underwriting. So I would always have a backup plan. Chase is still doing jumbo. They're not doing jumbo cash out. We've got Mutual of Omaha, TIA. We do have other jumbo investors, but whenever you can do a conventional loan at 510 and do a second lien right now, you know, I know Frost goes up to, they don't really have a second lien loan. You probably go up to 500,000. It's probably a better bet to do a conventional first and second if you don't want any surprises down the road with any jumbo underwriting.
Awesome. That was super helpful. Well, on the topic of loan products, right? John, I am hoping that you can help us understand and shine some light on, right? What loan products right now are being most affected?
Yeah. And I just wanted, and speaking of products and rates, they go together, right? I want to talk a little bit about FHA loans and VA loans out there right now. The problem with FHA and VA loans right now, we've seen the LTV requirements get a little bit worse in some products depending on the credit score, but the debt to income ratio and the credit score requirements are jumping on those. And the reason that's happening, and we're seeing higher rates on the government side, is because the servicing portfolios have lost their value and nobody really knows how to calculate the value of what that mortgage-backed security is going to be in the future because of all the changes right now. So you're seeing extremely higher rates than they should be when it comes to the FHA. So on the point of locking, I would say any loan you have right now, I would just lock it in. If you feel comfortable with your rate and payment, get it locked in and don't worry about it, because as Xander said, we were seeing 200 and 300 basis points move in a couple of day period last couple of weeks. And so just jump on a good one. So yeah, so FHA loans, a majority of people out there have gone to a 680 credit score. Our company's still at 660 right now. But I would imagine that everybody's going to probably be moving to that 680. They want to make these portfolios more attractive to the secondary market. That's why they're doing it. And you'll see a big discrepancy in the rates too. So the price of a rate between, like, say 4.5 and 3.5, it's not that great. The banks really don't want to do those high interest rate loans because they know they're going to get refinanced, and on a mortgage-backed security, the break-even is about 3 years on those, right? And if somebody's going to refinance in 6 months, it doesn't make sense for it. On the jumbo side, like Xander said, we're still doing a lot of jumbos out there. I would agree that the rates on the adjustable rates are much better than the fixed rates right now. In fact, we're definitely counseling our clients to go with the adjustable rates for now until this all blows over. And I'll let Greg talk to the kind of the non-conforming, non-QM stuff, or the exotic loans that are out there. And I know, because I know he's still doing them. But I think that where the sweet spot's going to be for where the greatest demand is going to be in the conforming market up to that 510 and 350. So if you stay within that, you're going to have a larger buyer pool because it'd be larger demand for the houses that are selling out there. And to be honest with you, we're still hearing on the conforming side multiple offers every single day. We had a client the other day on a $600,000 house, had 14 offers they were fighting against on the property. So the Austin market, the demand's been so high for the last couple of years that even if we have a 15 or 20% drop in demand, I think we can absorb it pretty quickly. There's an interesting stat that I saw that in 2004, we had like 1.4 million people here in the Austin area, and there was like 114,000 listings that year. And then if you fast forward to last year, there's 2.2 million people in the Austin area, but there was less than 100,000 active listings last year. So 800,000 people more, and actually less listings available out there. So I think we can absorb that lack of demand out there. So talk to your clients. FHA guidelines are tightening up. VA guidelines are, and so are USDA. Stay with that conforming, those Fannie Mae, Freddie Mac loans where we're getting drive-by appraisals on a regular basis, or property inspection waivers, which are even better. And be careful in the jumbo market. Make sure you're using a local, reliable lender like these guys here, right? Because, you know, I've heard some horror stories lately about some out-of-state lenders who aren't even funding loans once they get to the table.
Hey, John, so you mentioned drive-by appraisals. Can you explain a little when that's happening and when that's available and when it's not? How does it decide?
So let's talk about government loans first. So this is our stance. We have to order a full appraisal if our automated underwriting says we do. But if the seller, or if it's a refinance, the buyer, are uncomfortable with somebody going into their house, all they have to do is tell the appraiser that, and then the appraisal can switch it and make notes to just a drive-by appraisal, right?
So it's really driven by the seller?
Or if it's
Right
a
now?
refinance person living in the property.
Yeah, sure.
Correct,
Okay, gotcha.
correct. So if they say they don't want anybody in their house, then that's fine. We'll move forward and just do a drive-by appraisal, even though our findings may say we need a full appraisal on it. And then you have the PIWs of the property inspection waivers. And actually last week, Fannie came out and said they're going to start offering more of those. In fact, we run some of our old files through the automated underwriting system that were not getting property inspection waivers, and now they're actually getting them. But the important aspect of that is you have to, once you order that appraisal and it goes into the system, you can't go back and do a property inspection waiver. You have to do it up front.
Oh, gotcha. Okay. And then I know that Xander mentioned one of the hurdles right now was with appraisals. I think you said, Xander, you was taking 2 to 3 weeks longer.
Well, let me give you an example. We were ordering appraisals yesterday, and I think the earliest due date we were getting was like April 18th and 19th and 20th. A lot of them, as he said, are just taking themselves out. They don't want to do it. If you have a specialty property, think about this. If there's a special property that's maybe on some strange acreage, or the house is a little bit strange, or whatever it may be, there's appraisers, they're not even being picked up. Nobody will even do them right now. So that's what you got to watch out for, especially on the upper end. Just unique properties, you're going to have a hard time even getting an appraiser to accept the order to do it. And it's going to take 2 or 3 weeks to get that appraisal in sometimes, depending on what area of the state you're in.
So in terms of advice to agents, what other contingencies should we be thinking about or putting in contracts we're writing today?
Well,
Longer appraisal time periods, but are there anything else? Longer financing period?
Probably would think that there might be problems with inspectors going out to the property too, within your 10-day option period or whatever it may be, right?
Okay.
If you have to get a survey on the property, it might take longer to get a survey on the property. Obviously, the appraisal, it could take a little bit longer. What we've done with our office is we're advising everybody to lock on a 45-day, even though last month we were at 21 days application to clear to close. We never know what's going to happen with the appraisal aspect of it, right? So we're actually offering 45-day locks at the same cost as a 30-day, just to say, listen, you can do this. So for an agent out there, go ahead and write a 45-day. Say, listen, we want to close on it before this, but we don't control a lot of these third parties, like the survey, the inspector, the appraiser, things like that. And if you think about it, most people don't want to order an appraisal till the option period is up, right?
Sure.
That's 10 days into the transaction. Now you're closing in 30, you've got 20 days, and the appraisals may be taking 15, 16, 17 days. You know, you're up against a wall at that point.
Yeah. So I have a question for Greg. Greg, I hear that you've been really busy recently. So can you kind of walk us through and tell me what you've been busy doing?
Yeah, sure. Yeah, absolutely. So what South Star Bank specializes in is portfolio lending. And what that means is that the loans that we originate in books, they stay on our bank's balance sheet. So they're not sold like most of your traditional mortgages. They're all done under, you hear some of these other lenders, you talk about automated underwriting. So none of our stuff is automated. It's all manually underwritten. Mm-hmm. All of the loans that I originate, I also underwrite and I also approve. So that's really what makes South Star Bank unique, is that these files aren't being shipped off to an underwriter to review. When the file hits my desk, I'm the guy making the decision and underwriting the loan. Now, with that being said, we look at our lending as more like a common sense type approach, to where, since these loans are being booked on our balance sheet, we have our own underwriting guidelines. So if you have clients out there that have had trouble getting financing or getting financed, those are the folks that we like to help. And some good examples are, we're still doing a lot of jumbo loans, jumbo cash out, lot loans, construction loans, one-time close. We really haven't stopped lending in any aspect. Now, with that being said, obviously, your more conventional way to go is what the ultimate goal is. But if you have a client that has been declined or has been bounced around from bank to bank, those are the folks that I want to look at to help them out, get them in the house. And then at some point we help them refinance it and get it into more of a traditional type loan.
Greg, why do you say that's the ultimate goal, is to go conventional? What do you mean by that?
Sure, because all of our portfolio, because these loans are held on our bank's balance sheet, all of our loans are put in either a 5-1, 7-1, or 10-1 arm. Okay, our rates, because of the risk that we take, they're not, when you do a traditional mortgage, they're sold off, right? So that's why the rates are better. On our loans, our rates are a little bit higher. However, we're able to help people out. And the reason why I've been so busy is that, I wasn't the only guy swimming in this pool. There were some other lenders out there that kind of swam in these non-QM, but they were priced lower than me. And so I competed against them a lot. I won a lot of business. But if you had a rate shopper, I wasn't selling so much the rate, I was selling the relationship. And now you hear, like last week I took, I had 17 applications, is that you have these other lenders who were lower than me in rate that have sent out blanket emails and blanket letters saying, sorry, you have a loan in process. We're no longer lending. We're sorry. And to where, what I was selling was relationship. Being here as a community bank in times like these, I think it's very important to show that we're still running strong, we're still originating loans, and we're still closing loans.
Well, and I think what's important is something that we've always preached, right? Which is that, like, you want a bench, no one wants to go into the game with no one on the bench. And so it is a wealth of relationships that's always important, a diversity of partners that's always important. And I think we're seeing that here. I know we've gotten some questions on forbearance and on investors. And I think, Tasha, you're more equipped to frame that up for Josh to answer, because as you guys know, I am not a practicing agent, and I would never try to claim like I know what I'm talking about in this world. So Tasha, I would love for you and Josh to kind of have that conversation for our now 93 people in the audience, which is so exciting. So will you do that for us now?
Yeah, absolutely. Absolutely. Josh, I'll just defer it to you. What advice would you give agents that we can pass on to clients and friends when they're asking, I can't make my payment, I lost my job, I'm concerned about making my mortgage payment, and then investors that have, multiple investment properties that are mortgaged and tenants can't pay? Can you tell us about, our options for that and advice to give for people?
Yeah, so a couple of things. So, of course, the CARE Act basically came out, and it's made a lot of people eligible for a forbearance. Forbearance basically is just that you can skip the payments for a while, but it doesn't mean that the payments go away. At some point you got to make it up. It's kind of like when you buy furniture at a store and they do, no payments for 3 months. Well, eventually you got to pay it, right? You got to pay it back. There's a lot of uncertainty as far as the time that's going to be allowed. And then is that going to be put on the end of the loan, or is that due in 12 months after the forbearance is up? So a lot of unanswered questions with that. It's also based upon servicer. I also think too, like with the forbearance, I know that, the call times are insane. I've heard people say that 2, 3, 4 hours to get on the phone and not even get through. I heard from a friend of mine, a lender in town, got 8,000 calls yesterday.
Oh my gosh.
So that's a lot of people calling to talk about forbearance, and that's not going to be like a minute conversation, right? So it's just not the capacity. So,
So are you finding that most mortgage companies and lenders have a blanket statement across the board for everyone that they're offering, or you're not going to get an advantage unless you call and wait on the phone for 4 hours to get that answer?
I don't know. I think people are just trying to get information about it. I think more just an inquiry. Forbearance also, it's going to be available like on your FHA, conventional, USDA, VA loans, but a lot of the jumbo stuff, I don't think it's going to apply. That may change, but when I think about the forbearance, like to me, it's it's like a last resort. Like that should only be done if you have no other option at all. Because if you do a forbearance and you don't make payments on your mortgage for 4 months and then you decide to sell or refi, whenever we pull credit, we're going to see there's no payments being on a mortgage. And a lot of lenders are now coming out with, if you have any forbearance that's not settled, they're not going to give you a loan. So it could impact your ability to buy or refinance later.
That's a good question, because I mean, that's a good answer, because I'm getting that question a lot. If it will hurt your credit, and it sounds like the answer is yes, it could.
Well, it's not going to hurt your scores, but it's going to hurt your ability to get a loan. So I guess
Yeah.
your credit's still the same. They just won't,
I see.
that's
Yeah,
kind
that's
of like a roadblock. And
Okay.
I think too, the biggest problem with all the forbearance is that the media and all the news talks about just call in and get the forbearance, and really it's like an honor system right now. From what I read, it's an honor system. So if you say you've been impacted by coronavirus, well, you can get forbearance. Well, there are a lot of people out there that really need it that aren't going to get it because the person that's taking advantage of it is maybe requesting it.
A lot of these
also, go ahead.
I was just gonna say, a lot of these loans also, they have escrow accounts, and that would still be due, right? Even if you do the forbearance, or how does that work?
Well, that's a big question, right? Because if you have a lot of loans, if you have 25% of your loans with a forbearance and all those payments aren't being made, all the taxes, insurance aren't being made, who's going to pay that? If it's a conventional loan, the servicer, is off the hook with making the payments to the bondholders. But if it's an FHA or government loan, even if people don't make payments, they have to make the payment. So if Wells Fargo has a bunch of, FHA or VA loans and 25% people stop paying it, they've got to make all those payments. And that's why you're seeing all the changes with FHA, VA, all the score requirement changes, because they're scared. I mean, it's like if you add more loans and you're afraid that you're going to be out of cash,
So Josh, stupid question maybe again, because I'm not a practicing lender or real estate professional, but so say you have to skip 3 payments, right, on your mortgage. Does that then just get tacked on to the end of your mortgage, like the life of the loan, or how is that remade up?
Well, that's still in flux. I mean,
Okay.
I've heard it'll be tacking the end of the loan, or it could be like a balloon, or, it could be some kind of variation, but, the interest is still there. It just kind of gives you a break. But as of right now, I don't have the answer to that. And I think it's going to happen. It's all going to be servicer dependent, because there's obviously, hunters out there that service loans. And so I'm sure they'll all have their own guidelines.
Well, and honestly, I appreciate you, being honest and saying we're not really sure yet. And I had intended to include some of that dialogue in the introduction, which is that we're aware that y'all's requirements and things are changing hourly. So the idea that you would come to, the table, so to speak, today and have all the answers, we knew that that's not the case, right? And so I appreciate you guys even being able to come on in this manner and do what you just did and say, you know what, we're not sure yet, right? Because the worst thing to do would be to pretend that so to speak, when you don't. So I appreciate just the candidness and honestness in that answer. Xander, I've got some questions for jumbo loans. And also, to those of you that are watching the now 90 plus, keep in mind there is a Q&A function at the bottom. Right now I have 3 that have come in that I will get over to our lenders before we close out. So if you have questions, write those in and I'll address those before we end. But let's go on to jumbo, Xander, right? Why have jumbo rates gone up when conventional rates have remained relatively low?
Instructions in the help section of your Alexa app.
Hold on. Turn off Alexa here.
I love it. Hey, we're live and that is A-okay.
They're listening.
Yeah, of course.
That's a great question. The jumbo investor pool is.
In your Alexa.
That's so funny. Hey, it could just as easily have been like a kid, Did you just throw it?
Alexa just took a walk. The jumbo market is completely different from Freddie and Fannie. So one of our investors is a private equity investor, and they're the most exposed whenever you have a liquidity crunch, and they just completely pulled out a few weeks ago. The more capitalized jumbo investors, a lot of these products are hedged on Wall Street and retraded in mortgage-backed securities. There's just very little appetite for additional risk right now. So when that happens, jumbo fixed rates are in the 4s right now. and they were down to 3.25. So that's probably the biggest swing we've seen is in the jumbo rates, which is why, as John said, we're doing a lot more 7-1 and 10-1 jumbo arms, because that's much better rate and still in the mid threes right now, which is still pretty cheap money. And 7 to 10 years is a long time.
What is that? Help me understand. What's 7 to 10? Like if I'm new in the jumbo, help me understand.
Okay, so it's still amortized over 30 years, but the fixed period is either 7 years or 10 years.
Okay.
Right. But the rate spread between the 7 and 10 year arm and the 30-year fixed is over 0.5 to 3/4 of a point, if not a point on some products. The odds of you being in that loan more than 7 to 10 years versus 30 are pretty low, or you can always refinance later down the line, because jumbo arms are always fairly competitive. So we're recommending that if you are, say you got a purchase and you have to do a jumbo loan, you want to have a loan to value under 80%. So you want 20% down. You want to have FICOs at least at 700, if not to get 740 or higher to get the best rates. And your debt to income ratio cannot exceed 43%. So that's always been the standard guidelines. There were a lot of non-QM products that went over 80% or over a 43% DTI. And those are gone, completely gone, overnight, off the shelf, canceled locks, canceled fundings. So the markets, after they learned a little bit in 2008, they don't hesitate to move quickly when there's billions and billions of dollars at stake, because they won't be able to resell those loans.
Okay, so Barbara Van Dyke wrote in to say, does cutting jumbo loans impact houses that are already in escrow or just new loans?
Just new loans. It does affect the ones that are that are under contract right now in terms of underwriting is going to be a little tougher. I mean, ideally your loans being underwritten in-house. You know, we're correspondent lenders, so we're underwriting and funding everything in-house. But some of our investors are wanting to sign off on that loan before it funds. And that's always, they're going to take a very careful look at things. So the faster you can get jumbo loans in and out of your pipeline right now, the better. Okay,
great. I have another Q&A that John, I'm going to direct your way. Kim Zipful, wrote in to say, if the rate lock time frame is changing from 30 days, what time frame are you offering now? 45 days, 60 days? What do you have to say to that?
Well, the more time you have in a lock, the more expensive it is. So let's say like a 15-day lock compared to a 30-day lock is a different price. It could cost an eighth more for the 30-day lock. 45-day lock, 60, whatever the company sets theirs at. Ours are the same as a 30-day, as a 45-day. But as I said earlier, we're still closing things. They're getting our clear to close within about 21 days when the appraisal comes in quickly, right? But yeah, the only reason I'm saying 45 days to write a contract is because there's so many unknowns. It may not be the mortgage company that where the backup is. It's probably going to be the appraisal aspect of it, unless you get a property inspection waiver. But you're going to find that out from your loan officer once he runs that through the automated system with Fannie Mae, right? And it depends on the property type too. Is it a multifamily investment property? Those could be harder to be assigned, right? It might be harder for people to find comps for it. And that means appraisers don't want to take it because they have so much business that they can just go, why would I take this tough deal? It's going to take me 6 hours to do when I can take 6 other deals, right? And make 6 times the money. And unfortunately, that's just how it is, right? So when I'm saying doing 45 days compared to a 30-day on the contract, it's just protecting your client in case something happens. Now, I know there's multiple offer situations out there that we run into where you can't do a 45-day, still write the 30-day. But if you're going to do that, make sure your buyer is pre-qualified and maybe even pre-approved with their current lender, right? It has all their documentation, everything's been vetted already. And then once they do find a property, you're really just waiting on the property conditions to come back.
Okay, awesome. I appreciate that. I have another question typed in. It's kind of vague, Barbara, but I'm going to throw it to Greg. And however you want to answer this, right? It's up to you. So Barbara wants to know, quite simply, what about Bank of America? That's the only context I have for you. So what do you want to do with that?
Oh, well, I mean, I worked for Bank of America. I started my career at Bank of America. Actually, I worked there for 15 years. I don't know what to say to that. I think I think what you need to do is find a lender that is, how do I say this with being PC?
Right.
You want to find a lender that's in it for the relationship and not just a number. Your big guys, your Wells Fargo's, your Bank of America's, they're massive. And to you, most of the clients, you're a number, and that's it. So, I think that's where having panels like this really come into play is that, we're all local guys and gals here. We're in the community. We're here to help. We're here to build relationships and not just book a loan and then push you aside. And I think when you look at a lot of the big banks, that's really what you're getting.
Okay, Xander, Barbara said you mentioned that Wells Fargo had cut their jumbos. Do you know if B of A has done so also?
They haven't yet. Neither has Chase. You could see the big, when Wells does something, Chase listens. That they compete. The three banks really compete with each other on mortgage products. California's always been a big test market for them. So when Wells does something, Chase will look at it, but they may look at it as an opportunity to get more business too, because Wells has always been the top dog. One other thing is, following back on a former question about what realtors should be aware of things that could impact loans and closings and funding. So that's what you guys are here for. One of the things that's going to come up are verifications of employment at funding. We have to do them up front and we have to do them at funding. And it varies by product, but stay in close contact with your clients, because we certainly are. Whereas if somebody's laid off during the origination cycle, it's going to be very hard to close that loan. They have to be employed up until the date of funding. Now, if you're self-employed, we just have to verify that the business was still in existence through a third party 10 days prior to closing. So there's different procedures. We're kind of learning all this on the fly, but one of the reasons we're trying to get so many deals in and out of our pipeline as fast as possible is basically while people still have a job. So if you're not currently employed, it's going to be very hard to get a loan.
Okay. All right. Hey, Josh Brown, we've had another question come in right now from Brenda Burke. Thanks, Brenda. So Brenda wants to know, are lenders heavy with refinance files right now? When will that slow down? Will that have an effect on the appraisal timing?
I would say a lot of lenders are probably busy with refinances right now. As far as when it slows down, I think the rates will be low for quite a while, just based upon where things are right now, what the Fed's doing to, pump money in the bond market. And, as far as the impact on appraisals, I think it really depends on what the lender they work with. Because I know that on about half of my loans right now, I'm either getting like a property inspection waiver on DU or a waiver on, LP, which is basically, Fannie and Freddie, both of those. And so 50% of my loans right now don't even have to have an appraisal. So I would just say, as long as the lender knows what they're doing and they can do the waivers, and there's some gains you can pick up there. And then, as far as, our stance on it is, the refinances are it's great, helps people out. It's definitely a good thing to do for someone, but our business model has always been purchase only, because the refis will come and go. And so, our company, everything is done, they get the priority. So it's always going to be the top number one thing, because that's always going to be here, people behind selling houses. So.
Interesting. Josh, while I have you, what can you tell me about government loans? We've talked quite a bit about jumbo loans. Curious what you have to tell us about that.
Well, as far as what, you're just overall, or?
Yeah, especially just like living in San Antonio, right? Where I'm sure we have some people listening in from there. Wondering what your question is, or what kind of, information you have on how any government loans have been affected through this.
Well, the biggest thing I think with the government stuff is that a lot of the parameters of, because the biggest, the the hard thing about government loans now is that all these loans have to get sold eventually, right? So even if you're, you know, if you service your own loans or don't, like, you still have to make the payments of the loan, the full payment, if the person makes the payment or not. And so if you've got 25% of people out there unemployed, well, there's a big fear that those payments aren't going to be made. Who's going to make them? The servicer. And then go back to, back to having liquidity. And then you're just seeing a tightening of the guidelines on them, which I think, so John kind of mentioned already, but I mean, essentially, I just think it's going to be kind of like '08 where it'll tighten up, it'll kind of level out, and then as things kind of calm down and people know what's happening and the future seems like we have some insight of what it's going to be, I think it'll probably go, probably relax. That's probably what's going to happen.
All right. And of course, Tasha, if you have anything, kind of questions that you've been listening in from the agent perspective to ask, I do have one more that's sitting in my Q&A box. John, I'm going to bring this over to you because it's appraisal and inspection related. So Barbara wants to know if appraisers are not doing property inspections, how do you see that impacting appraisals making value? Great question.
Okay, so when we're talking about PIWs or property inspection waivers, right? We're going to take the contract price off the contract, put it into our system, and run it through Fannie Mae or Freddie Mac's automated underwriting system. And it'll come back with a value, whether it accepts that value or doesn't, whether we have to do appraisal or not. So if it says yes, then we don't have a value problem because that's the contract price, right? Now, when it comes to doing a drive-by appraisal, as opposed to doing an interior inspection on a property, yes, there could be some value issues there, right? What if somebody's fixed up the property inside and there could be adjustments made on the appraisal for a higher value? So each one of those is going to have to be taken individually, looked at, and as the agent, as the listing agent or the buyer's agent, if you have this information up front, then get it to us before we order the appraisal so we can get it to the appraiser so he can make those notes, right? Maybe they have additional pictures that they can show him all the work that's been done if he doesn't go inside the property. Does that make sense?
It makes sense to me, so.
Hey, Greg, question I'd like to come back to you if you have a second. We could probably do a couple-day webinar on this one topic, but can you give a high-level, some nuggets on what agents need to know about the Paycheck Protection Program?
Yeah, absolutely. And this is, this will probably affect every agent that's online right now. So this is, this was part of the stimulus program. It's through SBA. Going into this, what this allows is for agents, whether or not you have actual payroll or just yourself, to go in and get approved for a loan to help with to cover either payroll or to cover paychecks yourself. There's a lot of information about this. I have tons of documentation, YouTube video that I'd be more than happy to share with everybody online if we've got an email list. My best advice is this, at least look into it. Go to your bank that you bank with first. However, if you bank with a Chase or a Wells or the big guys, none of those guys are ready to do this yet. So even though it's opened up today, most of them are deferring them over to smaller banks like ourselves. We have opened for business to do them today. However, we are taking care of all of our existing clients first. We are taking care of any and all of our realtor partners that have relationships with any of our lenders. We're kind of taking care of those folks first, and then everybody else is on a first come, first served basis. I think before we even opened this morning, we had several hundred applications in queue. Now, these are forgivable loans, but there's a lot of moving pieces. So, again, this could be an entire hour presentation just on the PPP. So anybody that wants to be more than happy to share it.
Wow. That's great. Maybe you could post that too in the chat, the YouTube link. that would be great to share that if you have.
Well, actually, I'll do one better. So everyone that's on right now, we have all of your email information that they use to sign up for the webinar. So we'll send you all a follow-up email, and we'll collect different resources from our lenders to be able to put that all in one spot for you. Greg, that's super interesting because, you know, I've been logging into my Chase, right? This is my commercial lender. I got an email from him late yesterday that said, I don't think we're going live today. But super interesting that smaller banks who have relationships with clients that are already in are able to push those through. So, wow, that's interesting.
Yeah, that's great.
Tasha, since I have your lovely face in front of me, I think that I'd be remiss if we didn't kind of touch on a little bit about your perspective, right, as an agent. Again, on the front lines in a different way, right? So you're filtering questions from buyers and sellers all the time, and then leading out to your partners to help fill you with information to kind of funnel back them. So basic question that I bet is on a lot of people's minds: is now a good time to buy?
Yeah, I hate to say it depends, but that's normally my answer. It depends. It's such a, even within the greater Austin area, everything's on a micro level and micro markets, that it's not cookie cutter. I made some bullets I wanted to share with just what I'm seeing, and I would love to learn from everyone else as well. But you know, what I'm seeing is the sellers that are on the market and the sellers that are out there and active, they're more motivated. I'm finding that sellers are motivated right now. So in that regard, yes, it's a good time to buy. There's less buyers out there today, and a lot of people with the shelter in place, you know, staying in more, and so less showings, but the ones that are looking are motivated. They're very active, and my buyers that are looking are making offers. And also there's multiple offers. I mean, we had 2 clients this week competing in multiple offers. I know one of the guys commented on 14 offers on a property. So, you know, we're still seeing multiple offers as well. Obviously there's less inventory. I know, I think every single person has commented on that today, but there's definitely less inventory. Inventory was tight before the virus, and now it's super tight, even more so. I suspect there'll be more inventory once the shelter in place is removed, but then there's going to be more buyers coming out as well. So I'm not sure how much we'll fill that.
Well, and to your point, I mean, it's like we said earlier, right? If you don't have an answer, the worst thing you could do is try to give one that you don't know, right? And so as advisors, which is what real estate agents really ultimately are for their clients, like, you know, it is your fiduciary duty, I suppose, right, to advise them to the best, but also just to be humble enough to say, we're not sure, right? And so I think that's kind of what I hear you saying. You know, a lot of people are wondering, though, is there going to be pent up demand? And I have heard the phrase cautiously optimistic. I have heard that used more in the last 2 weeks than like my entire life. Do you echo that kind of sentiment?
Yes, absolutely. Absolutely. Yeah, I do. I think I'm getting lots of questions from past clients and people that were thinking about listing and now are reconsidering or wondering about the timing. And I think in all the questions that I'm getting from current clients and past clients, I'm trying to just ask myself, what would I do if I was in their situation? And it depends, because their situation's different than mine today, but what would I do if I was in their situation? And just trying to be a trusted advisor to everyone I come in contact with, just trying to be that trusted advisor, because this will pass, just like 2008, 9-ish, it passed. But if we can be a good resource, and if we don't have the answers, to put them in contact with the people that do, and just be the person they trust, business will come back once this passes.
Awesome. No, I am so grateful for all of y'all taking time. It wasn't just time this morning for the call, right? We've had a few prep calls before this. We've had some run throughs. So I know that right now y'all are fielding questions left and right from your loan officers, from your managers, from your agents, from your customers. And the fact that all of you would take time to give to Platinum Top 50 and our community this morning, it is not lost on me. And I am so appreciative. I do want to run through in closing, community out there, if you're listening, we are still here to serve, right? I realize that now is not the time for us to hermit up and go work on internal processes and projects. It's the time to show up and ask ourselves, how can we serve? And I'll tell you, having a business model that for 11 years has relied on live events, it was a little daunting at first, right? But myself and my team, showed up. We asked ourselves, how can we serve our community? And we've been successful in being able to turn some of those live events online for you. So we are here to go through this with you. Mark your calendar. That would be everyone. So next Wednesday at 9:30, we're rolling out a new webinar series that we're calling Peer Pressure. And it is very much going to be a peer-to-peer conversation, right? So Platinum Top 50, we have a wealth of professionals, a wealth of lenders, right, to source you information, a wealth of top agents, right, like Tasha, to help source you information. So next Wednesday, we'll be joined by Ashley Brinkman with Realty Austin, Chris Tennell from Compass, and Russ Phillips from Keller Williams. And next Wednesday, we're going to be talking about how do you empower buyers to move forward with confidence. And so there's a lot that we'll cover within that event, and one that we hope that y'all will join us for as well. So like I said, we are in this together, and the more that we can collaborate, the more that we can share and come together, the better we all will be when this storm finally passes. So in closing, I just want to thank everyone so much. I've gotten a lot of comments right now saying, thank you panelists, thank you PT50, y'all are awesome, this is great. And so thank you so much for sending that feedback our way. So in the meantime, you guys, it's Fun Friday, right? Fun Friday. Anyone have any good weekend plans? Joking, not joking. But look, let's find the silver lining in this in all of us, right? We're all learning new things. We're all coming together, and we're all getting more time with our family. And so anyways, there's a silver lining in all of this. So thank you guys so much. We are ending 3 minutes early. You're welcome. Okay, you're welcome. And just keep doing the good work, everyone. So thanks so much, and we hope to see you guys next Wednesday.
Thanks, Amber.
Thanks, Amber.
Yeah.
Bye, guys.
Bye.
Take care.
Yeah.
Stay safe.